Does January have you wondering what's going on in the stock market? Which direction it could go from here, and what does it mean for you and your future? Well, stick around for today's episode. We're going to talk about why we might be seeing some volatility in the stock market, what not to focus on, what to focus on, and how to prepare and plan no matter which direction the market goes from here.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome back to the Your Life, Your Money podcast, where we talk about thoughts, strategies, and actions to thrive in life, wealth, and retirement. I'm your host, Scott Searens, also president and financial advisor at Searens Financial Group. And in today's show, we're going to talk about the stock market. We're going to talk about what we were seeing, the volatility that was happening in January. What could that mean for the stock market, and how can you plan and prepare no matter which direction the market goes from here? If you haven't yet, check us out at lifemoneyshow.com. Again, that's lifemoneyshow.com, where we've got more podcasts, blogs, we've got videos, all to help you thrive in life, wealth, and retirement, and to help make sure you're on track to achieve financial independence. So January showed us one thing, right? January showed us that the stock market can go down. And why do I say that? Well, I think we've become so accustomed to the stock market going up and up and up and up that sometimes when we become so accustomed to something, we forget that something else can happen, right? And in January, we saw that the stock market can go down. And most likely, you'll see in your January statements that your overall values were down because the stock market was down. Now, I'm recording this on February 1st, about a week and a half before it'll publish. And maybe by the time that this publishes, the stock market has skyrocketed back up, or maybe it's lower than where it's at today. But my thoughts on what to focus on and how to plan, well, those thoughts won't change over the next week and a half. So why is the stock market going down? And I get it, right? Because when you get used to something going up, like the stock market, like the value of our accounts, for if you've got money in the market, when it goes down, it can feel really painful. And so why could the market potentially go down? Well, some just overall thoughts, right? When you're investing in stocks, when you're investing in mutual funds, when you're investing in ETFs, depending on what you're, purchasing, right? You might be buying or taking ownership in a portion of a company. And so, if a company's profits are down or if a company underperforms, that's a good reason for the value of that stock to be going down. However, there also are some times that cause volatility. Volatility are these like swings in the market, right? Some maybe drastic ups or some drastic downs in the market. So we see daily swings that go up and down a lot, or monthly swings that go where the values are going up and down a lot. And what causes this volatility? Well, you can almost kind of look at the stock market as a human, right? And as humans, what's one thing that we just don't like? We don't like when we can't maybe control things, right? Or we feel like we're in the unknown. And the stock market's very similar. When it's kind of in this world of unknown, or there's a lot of things that it can't control going on, right? That causes a lot of volatility. Just like for us as humans, when we're sitting there in the unknown, we might have some volatility in our gut or our stomach. The stock market gets some volatility when there's a lot of unknown going on in the world and economic conditions. And so let me just kind of walk you through what some of those things currently are. And for a compliance perspective, it's really important to tell you as well, right? Past performance is not indicative of future results. And that goes both ways, meaning past negative performance isn't indicative of future negative performance, and past positive performance doesn't mean future positive performance. Again, it can go both ways. It's just important to understand that when you're investing. The other thing, one of my beliefs is that nothing is permanent other than change. Change is permanent, it seems like, in our world. And so just because we talk about these things today, you have to ask yourself, are these things permanent? So will this volatility be permanent? So again, let's talk about some of the things that are going on in the world, in the economic conditions today. One of those things is inflation. I'm sure you've seen it, right? The price of goods and services, the price of your grocery cart, the price of gas, the price of different services that you might use, they continue to go up. And since inflation's going up, I think a lot of us were hoping that inflation would start to fade away, meaning those costs of goods and services would start to kind of go back down a little bit. But what December showed us and January showed us is that the cost of goods and services have continued to go up. So one of the reasons why we might be seeing some volatility in the stock market is because of inflation going up. Now, because inflation continues to go up, the Fed is projected to raise rates. What does that really mean? Maybe you've heard this a lot, right? The Fed's projecting to raise the rates. They might raise the rates 2 times or 4 times. Well, what it means when the Fed projects to raise the rates is that they're projecting to increase the cost of credit. What does that mean? Well, what that means is that it makes loans, right? It makes loans more expensive for businesses and consumers. So for businesses that are generating revenue, but they need loans to go out and create new projects or to create new product or to create new services, if the money, right, if the loans become more expensive to be able to do that, well, then they might need to postpone some of those new products or new projects or new services. Us as consumers, right, if the Fed raises rates, that means that it makes it more expensive for consumers to go get loans. You might see this as you've seen mortgage rates kind of start to trickle up. And again, so that just means that it becomes more expensive for consumers to go get loans to do projects or to purchase things that they need. And so there's some potential here of the stock market being a little volatile, because what all of this means is that then there might be less future capital going around in the economy. Another reason why we might be seeing some volatility in the market is because of COVID and because of this fast-spreading Omicron variant. And there's some companies out there that might be lowering their forecast because of this Omicron variant and because of how quickly that it's been spreading. Another potential reason why the stock market might be a little volatile is the threat of Russia invading Ukraine. Here's the deal. Does anybody really know? You can sit there and read the articles and the headlines all day long, but in the end, nobody's for sure why the stock market is being volatile, why it decided to go down in January. There's a lot of thoughts out there. There's a lot of hypotheticals, but I believe that a lot of it's around the unknown that's taking part in the world and in the economic conditions today. So one of the questions that you have to ask yourself is, do you think that all of these unknowns will remain permanent in our situation, in our economy, in our world? Or do you think over time they'll get figured out and life, the stock market, everything will continue on? The other thing I wanted to kind of do is just put all of this into perspective. So I'm going to go through some statistics here. I'm going to talk about some data here that might help you put January in more of a long-term perspective. So we're going to kind of start with looking at 1 month, and then we're going to go and look at overall years throughout history. So let's just look at January and let's look at 1 month, right? And you might be thinking, hey, was it just me? Am I the only one that was down? And I think this will also help you understand what took place in the market in January. So first off, I want to talk about a few indexes, the S&P 500 and the NASDAQ index. Now, you can't directly invest in an index. These are measurements of certain types of companies out in the market. Now, you can go to different fund companies and get funds that replicate indexes, but you can't invest directly into an index. So the first is the S&P 500. Now, this is a measurement of the 500 largest companies in the United States, right? So our United States stock market index here. And I got the data here from MarketWatch, and it shows that the S&P 500 So that measurement of the 500 largest companies in the U.S., right, shows that they were down a little bit over 5% in the month of January. How about the NASDAQ? Now, the NASDAQ is a measurement of over 3,000 stocks, but here's some interesting things to know on the NASDAQ. When you see like the NASDAQ on the news or on TV, and here's what it's doing. The NASDAQ, over 50% of the NASDAQ is technology. So if you were heavily invested in technology, that could be Microsoft, that could be Facebook. If you're heavily invested in technology, the NASDAQ is kind of showing you what's a little bit of what's taken place in technology. Now, MarketWatch shows the NASDAQ, again, for the month of January, down a little bit over 8%, actually almost down 9%. So U.S. stock market down in January. The NASDAQ, technology, where it seemed like a lot of people were investing, that was down in January. The next two here I'm going to talk to you about are specific tickers that measure or indexes, tickers that are focused on a certain region and area. The first is EFA, and this is a measurement of large and mid-cap stocks, but excludes U.S. and Canada. So you can look at this as large and mid-cap stocks for developed countries outside of the U.S. and Canada. Here we go. What's going on in the international market? This ticker here was down just over 5% in the month of January. And then how about the last one here, EEM? EEM is a fund that's based on emerging markets, right? Again, outside of the U.S. EEM was down just over 3% in January. So if you're wondering, hey, am I alone? Should I have been somewhere else? Did I have the wrong, picks? Am I using the wrong funds? What's going on? Right here shows you whether you're looking at U.S. companies or whether you're looking at companies outside of the U.S., every region was down in January. From a general perspective, right? From a general perspective. This also shows you the importance of diversification. You can see that some regions were down more than other regions. And I'm guessing if we looked within these indexes, right, you're going to have some stocks that might have been up while other stocks that might have been down. This is a great reason of why you want to have diversification in your portfolio. But again, what does this tell us? It tells us no matter which region you're focused on, you're going to see a decline in January. Maybe because of some of those reasons that we had discussed earlier. Now, the next part to understand, is this usual or is this unusual? And what I did is I went to the JP Morgan Guide to the Markets, and I'm going to link to this in the show notes so you can go and see the exact slide that I'm using here in my discussion. But they've got a slide in there that talks about intra-year declines versus calendar year total returns, and it shows for the S&P 500, again, 500 largest companies in the United States. So intra-year declines, that means from some point in the year when the market hit the peak, when the S&P 500 hit a peak within the year, but then like January, right, it went down. What was that decline? But then it's saying, hey, that was just, a portion of the year. What actually took place in that total year? And so I thought this really helps put things in perspective. In 2021, remember it or not, but there was actually an intra-year decline of 5%, heck, just kind of like we saw in January. But the total return for 2021 all of this is the S&P 500, was plus 27%. Let's keep going. 2020, intra-year decline of minus 34%, but the total return for that year was a plus 16%. 2019, minus 7%, but total return of that year of plus 29%. 2018, minus 20% for the intra-year decline. That year, the total returns still remained negative, minus 6%. 2016, minus 11% was the intra-year decline, plus 10% was the total year calendar return. So was this usual or unusual in January? Heck, I'd have to say, based on history, my belief is that this is very usual, that the stock market is going to go up and down. The other thing on this slide, I thought this was very interesting, and I wanted to share with you. It says, despite average intra-year drops of 14%, So despite an average intra-year drop of 14%, annual returns were positive in 32 of the 42 years. Think about that. Again, putting it in larger perspective. Despite an average intra-year drop of 14%, meaning seeing at some point in time during the year that the market went down 14% on average throughout the calendar that they're showing us here, that the annual returns were still positive in 32 of the 42 years. So again, taking this perspective, because I get it, right? When the markets go down and our accounts go down, it feels pretty painful. But we take this 1 month perspective or 1 day perspective, and we just need to grow it a little bit larger, because you have to ask yourself, are you investing for 1 day? Are you investing for 1 month? Are you investing for 1 year? Or are you investing for 5 years, 10 years, 15 years, 20 years, 30 years? And really base your investing on the perspective of how long you'll be investing for. Which takes us to our next point, focusing on what you can control versus what you can't control. So I think we've just shown here, right? We can't control the market. We don't know which direction it's going to go next because we can't control the economy. We can't control what's taking place in the world. And we're not certain what might happen next. So since we can't control the market, we don't want to focus on what happens each and every day on the market, right? So first off is we don't want to panic. We don't want to get caught up in the headlines that say, boy, the market's a roller coaster, or what a wobbly start to the year, or that the future looks bleak, or is the market crashing? Just remember this. All of those headlines that are put out there are to grab your attention. If they grab your attention, they get you reading that article, they get you watching that show. Now they're able to advertise to you, and that's how those companies generate revenue. So instead, we want to focus on what we can control. And this is why it's so important that we continuously talk about what are your needs or any major financial needs that you have within the next 5 years. Why do I use 5 years? Well, just like we're going through right now, right? The market could continue to go down. And maybe like in 2020, it bounces right back up. But what if we have like another 2008 where it took like 2009, 2010, 2011, 12, 13, where it's finally getting back up to even, right? That's like 5 years to get back up to even. So that's why I'm constantly asking what financial needs might you have over the next 5 years? And so we can start breaking things up into short-term financial needs as well as long-term financial needs. That's the importance of having the income plan in place. So we know how much you'll need to withdraw from your portfolio over the next 5 years. Again, focusing that on the short-term needs. And then 5 years and out, those are more the long-term needs. Why do we have these short-term needs versus long-term needs? Well, those short-term needs, if the market's down, we want to have those short-term needs in something that is safer, right? So that's the safer side of the portfolio. That's what I like to always call or nickname the war chest. What could that be? Well, it could be a portion that's maybe in cash, a portion that's maybe in bond funds. Sometimes people in their war chest like to use annuities. But again, it's just having those next 5-year needs over on that safer side of your portfolio. The other part is, again, back to perspective, if we're saying that we're long-term investors, because yes, inflation's going up and we need our money to continue to grow to buy goods and services in the future. Well, anything that we didn't carve off as part of those short-term needs, that's why then we've got the growth side of our portfolio. We understand that we're going to see volatility just like we saw in January, but we know that that money is future money, it's long-term out. And you just have to ask yourself, do you feel in the future that the market is going to be in a higher position than it is today? So short-term versus long-term needs, that's one thing that we can control, and we build our portfolio around that. The next thing that you can control, and I know this might sound a little different, right? But taking advantage of a down market as a buying opportunity. Here's what I mean. If you feel that the market in the future is going to be higher than where it's at today, then any point where it's lower than where you think that it might go to in the future is a buying opportunity, right? So you're buying on sale because you feel like it's going to go higher in the future. So when the market takes a dip from where it's at, that means that the market's even more on sale, an opportunity to buy, right, while it's on sale, if we feel that it's going to go up in the future. Again, having that longer term perspective. The other way that we use this as a buying opportunity is that we're rebalancing portfolios. So yes, while one portion of the market might be down, another portion of your portfolio may be up. And so you're selling portions that are high, buying portions that are low. That's a thought process called rebalancing, which we're looking at not only on a quarterly basis, but as we see different spikes in the market. The last thing that we can control our own thoughts in regards to the market. And if you're a long-term investor, it's controlling our thoughts and having a long-term perspective. Having a perspective, not just of 1 month, but looking at how long will your money be in the market? How long do you see as maybe the future for your life? So your perspective, instead of just being 1 month, it might be 20 years, it might be 30 years, it might be 40 years, it might be 50 years or longer. And you have to look back at the market and go, okay, hey, based on my perspective, what has the overall market done? And then utilizing that to not let 1 day or 1 month or 1 year have an impact on what those thoughts are. So wrapping up, I hope that you found this podcast to be of value and benefit. And if so, and you'd like to hear additional podcasts just like this, subscribe on your favorite podcast player. Also, check us out at lifemoneyshow.com. Again, lifemoneyshow.com to see additional podcasts, blogs, videos, all to help you reduce your long-term tax picture, understand what you can do to improve your overall financial picture, and help you build wealth and make sure you're on track towards financial independence. I really look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.